Good morning, everyone. We're just going to give it a minute or so to let a few more folks join, and we'll get started on the material for today. Thank you. Okay, well, I think we'll get started with housekeeping matters, and that will still allow a few more minutes to give everyone the opportunity to hopefully see the whole webinar. I wanted to, first of all, thank you for spending some time with us and welcome you to the first power session of 2024. Um, My name is Ezra Beam, and I'm Managing Director of Energeia. And today we will be talking about how we're going to integrate 2.5 times more rooftop solar PV capacity by 2050 at the lowest possible cost. I am supported by Sarah Gonzalez, who's going to be managing the chat, and feel free to put in your questions at any time. We will be saving them until the end during the Q&A session. Um, Please do stay around for that session. It's usually pretty interesting. Appreciate any of the questions that you have, and don't forget to vote for your preferred next topic. A copy of the webinar, as well as the PowerPoint, or link to the PowerPoint, will be sent later this week. And please forward it on to anybody you think might be interested. Okay, so without further ado, there it is. Today, we're going to be talking about hosting of solar PV, rooftop solar PV, and the least cost way to integrate not orders of magnitude, 2.5 more times of it over over the period of 2050. Now, much of what we would discuss today also applies to other emerging loads and generating sources, including behind the meter storage and vehicle electrification, which are two other potential drivers of grid costs and system costs. It's just that solar PV is heads and shoulders above any other challenge at the moment. We'll then talk across the whole range of integration solutions before deep diving into dynamic operating envelopes, which is the technology that I believe is largely been pioneered in Australia, in part because Australia's got some of the highest levels of penetration in the world. And it's a potential solution that we've done some work as part of Project Edge that we wanted to share with this group, and then we'll land on, or finish on the key takeaways and recommendations, and then on to the Q&A. So let's start with solar PV adoption and impacts. As you can see here, since 2013, which is only 10 years ago, the price used to be much higher. Um, Prices have almost halved by about 2019. We haven't updated this to the last 2 years, but we do expect the trend to continue over the next 10 years with new low-cost technologies coming into the fore. On the other hand, the retail prices that people pay have largely been flat over the last 10 years, although you've seen a significant uptake in the last few years, driven mostly by the cost of capital, but also the cost of fuel in the wholesale market. Now, we've put a dotted line here as to how much you'll pay for every kilowatt hour of rooftop solar that you can use. And this assumes 100% usage here and is otherwise known as the levelized cost of energy. And you see it varies a little bit from state to state, and that's largely due to the amount of solar installation and the level of STCs that you're given. But you can see here there's a reason why solar PV investment is continuing to grow and is expected to do so over the next 30 years to 25 years to 2050. So turning to exactly where we are at the moment. So this is showing solar PV rooftop penetration by DNSP. Now, this is of total connections. It's not looking just at single family dwellings. If you look at single family dwellings, it does increase quite significantly. Um, but fundamentally, you can see here with some of the networks, whether in South Australia or Energex's or Essentials, we're encroaching on 40% of uh, total connections, and that continues to grow over time. And there are some networks like Osgrid's and Tasmania, Gemina, and City Power, and there are constraints in some of these networks, particularly City Powers, as well as Gemina for single-family dwellings, for example. But we do expect most of these to continue to rise, especially if you're looking at single family dwellings. You compare this to overseas. Now, we haven't updated this since the Renew project, but it hasn't changed that much. Hawaii is about double anywhere else. You've got California and a few other states. In Europe, you've got the Netherlands, Germany, etc. But Australia is definitely out there in the lead. Now, in addition to penetration, right, the number of solar PV systems per connection, we're seeing a substantial increase in the average size. Now, note we've taken out any system greater than 15 kilowatts, because at this stage, that's probably more like a small business or multifamily dwelling. So we really tried to limit it to what we can expect to fit on a single family dwelling. It eliminates maybe some farms and whatnot, but we're still in the sort of 8 to 10 kilowatt hour range. So penetration's rising and the system size is growing, and that has impacts on a range of stakeholders in the energy system. Now, if you thought that we were pretty much done, or maybe double is where we're going to land, and it may be asymptote 2, you'd be wrong if you believe the market operator's forecasts. Here it's showing in 2024 what the total combined rooftop solar PV is at about 20 gigawatts, moving to just over 70 gigawatts by 2050. And that's where I get my 2.5 increase in the current level of hosting capacity. So the system needs to be able to accommodate, and is expected to accommodate, a significant increase over even today's values. So how's that going to get done, and what is the cost of doing so, and how can we minimize those costs? Right. So in other work we've done, and I wanted to just acknowledge the contribution of Renew, which was partially funded by EC, the Energy Consumers Australia funding. In that we reviewed what the cost of what are the issues that are being driven by solar P, first of all, and here's a whole list of them. Um, these are the integration costs. Integration solutions and cost estimates. Um, and what we find, what we're showing here is when you're trying to mitigate those costs from solar PV integration, the items in green, inverter standards, changing the taps of offload tap changers on transformers, and rebalancing the phases have been the go-to solutions for distribution networks and are relatively low cost. With the possible exception of inverter standards, in that it can increase the level of curtailment that you see on these systems. When these green items start to no longer be effective, the networks have to look at things like putting in static limitations, so reducing capacity from 5 kilowatts per phase to less, installing in larger assets or more assets, in particular more transformers on the low voltage system, or even looking at StatComs and storage. Um, Things that are in yellow have been identified as being relatively low cost, but more sophisticated and require more development. And this is one of the ones that we're focused on today, which is the dynamic limitations. And these estimates were provided on a per DNSP basis when we did the Renew project. So for the recent project we completed on behalf of AMO and AusNet with our partner Deloitte for Project Edge, we looked at the cost over time of these different solutions. This is just an example of relieving a constraint on a low voltage transformer for an additional incremental investment in solar PV over time. Now, you may not be able to use all of these options over time. Like for example, the lowest cost option here, the offload tap reconfiguration. Once you sort of put them to their maximum values, they're no longer. You have to put in a new transformer basically, or go to online tap changing. Likewise for rebalancing, there's only so much rebalancing you can do. Both of these are relatively low cost. I will draw your attention to the logarithmic scale here. You've got the option of volt var, which is a smart inverter standard that basically if voltage gets too high, it folds back and either changes the power factor and or curtails the amount of real power being exported. Now that increases over time because of the level of penetration and the level of curtailment that goes with it. And so it starts to creep up and is no longer really the least cost option. You see what comes in after that is the dynamic operating envelopes. But even dynamic operating envelopes, which seek to make the most of existing capacity, they still are constrained at points of the year and are dialing down solar inverters, for example. And so there is curtailment here. It's just not at the same level as you see using the smart inverter standard. Ultimately, what you see coming in below dynamic operating envelopes in the 2030 period are potentially new regulators, as well as controls for EV charging, for example. So this is, you could see this is a supply cost curve over time, and certainly dynamic operating envelopes are a key near-term technology that's going to be essential to see us avoid higher cost solutions like additional transformers, et cetera, that I showed you on the previous page. So let's do a deep dive into dynamic operating envelopes. So at a high level, what they're basically doing is forecasting what the load flow is going to be over the next 24 hours, let's say, and identifying where there's expected to be um, a thermal or a voltage constraint that the capacity then has to be allocated. There's only so much export capacity that's available, and then allocating it based on an operating objective. Now, the impact here is if you look on the left for a fixed sort of limit, that maybe you might get 1.5 kilowatts of export potential, which was the case with one of the DNSPs in Australia. That if you can't change it over time and you have to guarantee it works everywhere on the network, they identified that 1.5 kilowatts of export was the maximum. And so that's fixed by every hour over every month. Now, a dynamic operating envelope um, what it does is it might provide up to really the thermal limit, which could be 10 kilowatts per connection. But on the peak day of the year, whenever there's a constraint, you can see that it dynamically says, "Oh no, we're going to have to restrict what your export limits are, so we don't have any voltage excursion in this case." And we've given you links to the papers where you could find more information to read up on this technology. But you can see here, this is a much, I mean, for a large fraction of the time, being able to export this much is a much better outcome than only being able to export based on the worst case scenario of the entire year. And that's really the promise and the premise of dynamic operating envelopes. And this constraint, whether it's driven by solar PV or it's driven by people exporting batteries during a peak period, which will also increasingly have a constraint, or it's based on a constraint due to EV charging. These can all be managed dynamically using dynamic operating envelopes and freeing up spare capacity for 99% of the year. Now, over time, that 99 goes down to 98 and 97 and 96. But for a long period of time, it's freeing up existing capacity. So there are two real, in working with Project Edge, we identified with our project partners, the University of Melbourne, that there were really two major design elements of dynamic operating envelopes that tended to have the largest impact on how much capacity it freed up above fixed limits. And so here's a illustrative diagram for an illustrative network. You've got four customers on it. They have different mixes of solar and storage. And it's showing that it can, with the target optimization objective, this will change how spare capacity on the system is allocated. So, and the two ones I want to draw your attention to really are maximize service, where those connections, like connection 4, that are electrically further away, might be completely constrained off. DIR number 3 could be partially constrained, but DIR 1 gets up to 10 kilowatts because it's actually closest, and this maximizes the overall amount of capacity used on the system. But it's not a very fair approach, at least not on its own, because DIR 1 gets 10, DIR 4 gets 0. What tends to happen in fixed analysis is the equality outcome, where you have the same potential capacity, as actually the same potential capacity across all of them. And this is set so that everybody gets the same amount. DIR 1 gets 5, even though it can output 10. DIR 2 gets 5, even though it can't even meet 5 yet, et cetera, and so forth. But everybody agrees that this is fair because everybody gets the same amount. Now, there are other options, like it's weighted to how much um, weighted to normally how much system capacity you have. I guess that's maybe proportional, or other methods, and you can read more about these other methods. But the point we wanted to make here was that equality gets you a certain outcome, 5 kilowatts, but it doesn't give you as much output as you see here with the maximized service. And bridging the difference here in terms of fairness might require some kind of compensation to those folks that are being constrained off so that it can deliver a community maximizing benefit of having more export if that's what's needed. So when we actually looked at this in Project Edge, and so there's a lot of complexity here, apologies for that. Um, and let me just go through the scenarios with you first. Here under our modeling, we had two different kinds of DIR adoptions. We had the AMO step change, which you consider a moderate level, and then the renew level, which was more than double the amount of uptake. We had different nameplate functions, different objective functions. One is to allow just the nameplate to be optimized for or max service, and then participation, whether it was just those that are participating in VPPs that were part of the optimization, or if it was everyone. And that led to different levels of export limits per customer, and they fell over time because you had much more export. And what you can basically see here, so this grouping is of the higher DIR adoption, this is of the lower. And generally, if you wanted the most amount of export, it was maximizing the service and having 100% of DIR enrolled. And so that's, I guess, a policy insight there in terms of how do you get the most outcome. It's by those two assumptions. Now, is it the fairest? Possibly not. In fact, it probably is not. And so there from a social license perspective, the industry and policymakers really going to have to deal with, if they want an efficient outcome, how do they best address the fairness issue arising. And so what we saw here in the analysis using the load flow run by University of Melbourne, thanks to James for doing all this work, you can see here between a high uptake scenario, the key difference is whether or not it's VPP participation or everybody, all SER, all solar is actually participating. That if everybody's participating, you can see that the amount of available capacity, it does saturate after 2030, but it's up there at 200 kilowatts. So a lot more output is allowed. And the biggest constraint here is on the proportional. And when this is a minimum demand, so normally this is a PV constraint. You can see here that by allowing for 100% participator or for requiring everybody to participate, you get, I don't know, 5 times more than you're seeing here where it's just the VPPs. And part of the reason for that is that everybody who's not participating is assumed to be taking the worst possible um, operating decisions, and so you have to carve out that for them, leaving less for those that are actually being managed. Likewise, if you look at between the high uptake and the moderate, less of an effect. So it's really as we start to get more and more higher penetration that the importance of getting the design elements right of dynamic operating envelopes comes to the fore. Right. So this covers off on the scenarios that we've just looked at and what the estimated dynamic operating envelopes are without changing capacity, right? As soon as you start making investments in underlying capacity or uh, inclusion of cost reflective prices, et cetera, that will shift all of this up. So in Project Edge, we wanted to just leave you with some of the forecasts under each of the scenarios. So one was looking at the impacts to distribution versus wholesale. Curtailment, these are the two biggest drivers of curtailment at the moment and forecasted in the future. One of the key takeaways from this was that curtailment within the distribution network due to voltage constraints is going to be a much greater issue than minimum run curtailment. Just doesn't happen as frequently, at least in the modeling that we did. Now, turning that into dollars and costs, this is on a net present value basis, again by scenario, and you can see the network curtailment costs are orders of magnitude greater than the wholesale curtailment cost drivers, um, and that taking these into combination, really scenario 6, where you've got 100% participation, you're maximizing service, it's going to be the least cost combined outcome, mostly because network curtailment costs are lower. So there you have it. I think we get into the key takeaways and recommendations. So solar PV is not going away. Rooftop solar PV is not going away. It's actually going to increase by 2.5 times more over the next 25 years. And it's important that we implement technology like this. Otherwise, we will fall to a higher cost option. Um, Getting this in place will not only help solar, it will help other behind the meter resources, including storage and EV charging. And work we do in the US and in Australia shows EV charging is likely to be unmitigated in EV charging is likely to be the key driver of network investment over the next 10 years if nothing is done to integrate it well. Dynamic operating envelopes are really the next least cost solution after phase balancing, tap changers, smart inverters, and basic cost reflective pricing. After that, we really need to move to advanced cost reflective pricing. I don't know that it has to be real time, but certainly the prices to devices we've talked about in other webinars is going to be increasingly important because dynamic operating envelopes that have a finite amount of efficiency they can get you, and then increasingly the times of year that are constrained just grows. So key recommendations. One is to be able to forecast on a spatial basis because these effects in the distribution level are the most significant, and it's important that businesses take a systematic approach to CER or customer energy resource integration. All of the low cost tools in the toolkit should be tried and ready to go. We assume, and we've seen all the networks pretty much getting a hold of all these and using them well. But it's important that we look ahead to the second line solutions. Now, this is really a policy, although I think that the grids have a lot of scope here in terms of requiring participation and in determining using a service maximization objective, but to be wary of the social license issue here of fairness and make sure that that is tackled head on. Otherwise, it can undermine the whole initiative if there is a reaction by the community that's not acceptable. I think in the short term, it will not be so much of an issue because it probably won't curtail off folks that are further away electrically, but it's going to be an issue as penetration rises. So thank you for your attention and for your participation. Please, we'll start turning to the questions now. Don't forget to vote so we have some market feedback as to what are the most interesting elements for us to discuss in our next webinar. And just to highlight that our next webinar, we're asking you to vote on it, but we've already developed up the content here. So really, we're looking beyond this But it's the state of the art in virtual power plants. We think this is a really exciting topic. There are a number of them out there operating, but I don't know that everyone really understands how they compare. What are the key trends? What are some of the issues we're seeing? So we're looking forward to sharing that with you all next time. Well, and so far I've got one vote. Wait, no, we got more votes coming in now. So appreciate that. We'll let that percolate away, and we'll start doing the questions. So um, from Anthony, if high curtailment, is this a signal that too much PV built in the wrong location? Well, it all, in my view, Anthony, I think it has to be balanced by what is the cost of that solar PV system. So if it is constrained and there's a sort of voltage constraint, it's going to take $20 to resolve it, and it's generating $40 worth of value, then that is not necessarily in the wrong place. It could be in a better place, but is it adding value to the system? Is it creating value? The answer would be yes. If it's not, then the answer would be no. So from David, do you think that reductions in feed-in tariffs and moves to solar soak style tariffs will dilute the appetite for new solar PV installations? It certainly is providing more cost reflective signaling. Now, you could look at that as maybe reducing the value of solar, certainly exported solar, but it reduces the value of just energy generated in that point in time. Um, it's as much an incentive for things that can take advantage of those lower prices as it is to maybe invest less in solar itself. So, for example, moving more charging into the middle of the day, moving more battery charging into the middle of the day, these are some of the things that happen as a result of the solar soaking. So, to the extent, the main thing is that those price signals are accurate, because if they're not accurate, then marginal cost is not equal to marginal revenue. And as you've seen in our other webinars, um, that's not a good outcome. Okay, Abraham, how tariff reforms and flexible demand can affect hosting capacity, and what is the what is the competitiveness of these with other solutions? I think that's a really good question. Um, so I don't know that tariff reforms or flexible demand um, is affecting hosting capacity of the grid, right? Because the grid, given a load shape, is going to only be able to accept a certain amount of capacity. However, if you are putting more demand into the middle of the day, for example, because of these tariff reforms and flexible demand, then the actual hosting capacity goes up, even if the grid capacity doesn't really change. And how competitive they are they with other systems? We believe they are relatively low cost from a systems, from a change perspective. And we're not talking about, installing a new battery necessarily. It's really just offering an incentive so that an existing controllable hot water heater is actually put into that period. Most of the issues that we've seen are really institutional, um, uh, that are barriers, not the actual cost themselves. All right, from Rama, any comment on the consumer choice below? Solar plus battery, solar plus DOE, solar plus emergency control, solar with a conservative static export limit, with cost reflecting pricing through it. I almost feel like this is a function. Um, so how compatible are each of these different approaches with cost reflective pricing throughout the day? I believe they're complements and they're not substitutes. I It's just that, any of these things is any of these solutions is finite, right? And you saw the uptake curve on solar. So to the extent that we're not providing hosting capacity solutions that are least cost, of including cost reflective pricing or DOEs and et cetera, then we're going to have to move to higher cost options like additional transformers and other things, because we can guarantee we can get those out. And so that's going to be what happens. So it's really about getting ahead of these constraints, and being able to deploy the least cost option before a higher cost option has to be taken, just to ensure that you're not having a voltage excursion, for example. All right, thank you, Will. I know from the University of Melbourne class, great. I attended spatially mapping the LV networks tends to be much more difficult in practice. Oh yes. Well, we can talk about data availability, and I think that was a focus of the ESB. And I think Anthony last time pointed me in the direction of the consultation, and I'm just not clear when we're going to see any more visibility there. Right now, you can't get, I don't even know if you can get XY coordinates for zone subs, but you can at least get their load profiles. And I think we'd all welcome, and this was even part of the Victorian voltage consultation, more data would help market participants um, better develop solutions, better build business cases. Um, but yeah. Okay. Nick, are DOEs worthwhile if cost reflective tariffs aren't implemented? Yeah, no, I think that's a good question. Dynamic operating envelopes technically allow us to use more of the existing capacity. It allows for us to avoid fixed constraints on what can be connected. And so you unlock a whole bunch of potential investment there, and also allows them to operate more of the time without having fixed sort of curtailment or export caps. So definitely still worthwhile, but clearly the next step is cost reflective tariffs. Rama, how might we get DOEs to work for us on the demand side, not just soaking up solar, but also during peak demand periods? More broadly for non-network solutions, the value of topological flexibility. Well, so let's just start with the last statement. Topological flexibility is a very sophisticated future, in my view, future capability of the networks that they can change topology of the network as needed for a given sort of reliability event or what have you, and is a in the very advanced category in my view. Um, I think with the DOEs at the moment, we got to get them set up for solar. Once they're established, they can start providing signals to load, particularly um, flexible loads, and those loads will be the loads that can get moved around first before triggering something more expensive like an asset upgrade. Victor, the question is, do you know if the market and grid curtailment studies looked at the interactions between distributed and utility solar? Noting study was focused on CER objective function. Would the scenarios impact on utility solar curtailment? Actually, this is a really important question, and it's something that was specifically looked at in Project Edge. Because when it comes to curtailment, especially for minimum operating conditions, AMO generally has to follow a least cost solution. And if you look at the work that was done there, you'll see that we looked at, what is the curtailment price of a utility scale solar versus rooftop, and the answer that we arrived at, well, they're both zero cost to produce, but whenever you produce 1 megawatt hour of utility scale, you get a REC with that, or a renewable energy credit, and that's worth money. So they're going to bid up to -20 or whatever the REC value was to stay online. Whereas rooftop, it's a political thing, but nobody's got any RECs to avoid. And so that's the way that the two things were compared there. And rooftop was, politics aside, lower cost to curtail than wind or solar because of the ability to access a REC, and therefore be able to bid negatively. Rama, get the point about institutional barriers. Some might be roles and responsibilities, other technical. What are the big technical gaps? I don't know that I have not seen that this is a technical issue, and I was actually surprised. Like when we did the work for Edge, I was expecting, forecasting accuracy and frequency of update to be pretty important. But in the work that we found in the example that we were using, you can do a lot with an estimate and some pretty dodgy data. And so that wasn't really a technical issue about what the forecast state of the network was. I think, and we've worked on Doe business cases, and I think the harder thing to get right is how do you deploy it, right? Because if you go and just deploy expensive censoring in, if you ignore the fact that a lot of this can be forecast and estimated, and you do a high cost implementation, it's really high cost because a large proportion of your feeders aren't going to be curtailed, constrained anytime soon. So, um, excuse me. I think the art here is in doing a fit for purpose doughy deployment that gets the balance right of deploying this on the feeders that are more likely to want to be able to need it with and making fundamental investments, no regrets investments, but not over egging it. Rama, is it the case that you need cost reflective pricing to actually incentivize customers to sign up to doughy offerings? If you are paid a price that you see today, you don't have a lot of reason to change or to do anything. Like having more cost reflective prices creates the business case for market entry of service providers and technology, et cetera. So I don't know that it's necessary. It's necessary because curtailment drives the incentive, right? So not getting any money is the incentive. But better than that is getting money at certain times of the year to relieve constraints, et cetera. And that's what drives ultimately investment decisions by service providers that enable this market. What are we doing? Okay, well, thank you, everyone. We're a little bit over time. Appreciate everybody's attendance again, and we look forward to seeing you for our next webinar. Just note, it's not February; it's in March. So we'll see you again, hopefully on March 19th, 2024. Thank you, and have a great day.